Hi, this is Brent Green again. Just here to answer a couple of questions. One of the frequent ones I get is about the Federal Reserve and whether they set mortgage rates. The short answer is no, not exactly. They set the federal funds rate. That's the rate that banks charge one another for overnight borrowing. This rate would impact things like maybe a credit card or a home equity line of credit or a personal line of credit, car loans. It also impacts what you get paid on your savings account. So that's the short-term rates. Long-term rates are your mortgage rates. So coincidentally, mortgage rates did go down after the Federal Reserve lowered short-term rates. But that was for a totally different reason. Usually your rates, your long-term rates are set by expectations. So they're looking at what's the horizon look like for interest rates. Well, the horizon looks like the rates are going to come lower. It's a very good horizon as far as the rate environment goes. Low inflation, high productivity, all these things that lead for long-term rates to do well. The expectation is that the Fed is going to lower rates again, and the expectation is that trade is going to continue to be a problem. Right after the Fed lowered rates, trade became the issue, the news the next day. We instituted additional tariffs on the trade with China, and that does not bode well for economic output. It's recessionary, meaning that the Federal Reserve is probably going to lower rates again, meaning that the long-term outlook is for lower rates and that mortgage rates are following that. It's a coincidence that they lowered the short-term rate at the exact same time, but so much for the better for us as far as what we pay on long-term borrowings like a mortgage. If you have any additional questions, feel free to call me. I'm happy to help you. Thanks.